Hi, I'm Jim Morrow, manager of the Manning and Napier Callodine Equity Income Fund. This is a fund that focuses on the dividend-paying part of the stock market with a distinct value-oriented and high-quality approach to building the portfolio. We define value through the lens of free cash flow generation at the enterprise level and really examine how a company is allocating that free cash flow to both its existing business and growth initiatives, as well as how much of that free cash flow a company is sharing with shareholders through both stock buybacks and dividends. We view that last piece as particularly important to consider, as dividends represent a very public and somewhat permanent commitment to shareholders that they will consistently receive a portion of the cash flow a company generates each year. We view this as a very important behavioral signal that a management team is fully aligned with its shareholders. And in combining this signal with a true value investing approach to the equity income universe, we believe we can deliver truly differentiated returns over time. Looking deeper into how we find investment ideas, we take a very whole company approach, meaning we look at everything with a thorough examination of a company's balance sheet and cash flow statements. Work we view as often overlooked by many other investors who are solely focused on earnings growth or how big a story can be, so-called narrative investing. We are a true fundamental bottoms-up investor. This leads to a distinct group of investment ideas where we have very differentiated views on the capital structure or capital allocation trends for a business moving forward. We look for points in the natural cycle of a company where these capital allocation or balance sheet aspects will soon take center stage for the stock. Examples of these can be a change in the direction of capital flows. For example, when a company that has been paying down debt pivots and directs that excess free cash flow to the equity side of things. Balance sheet changes, such as an increase or decrease in the amount of debt a company has. Change in the cost of capital, which we're seeing a lot these days. With rising rates, many companies today face higher costs of capital than they have in many years. And lastly, dividend actions. Dividend growth and initiations are often positive catalysts for stocks, while dividend cuts can lead to losses. And so we have a real focus on getting these dividend actions correct. The spread in valuations between what is expensive in the market and what is more attractively valued is near its widest level over the last 30 years. Driven by gains we've seen in many growth-oriented areas of the market, which have left these stocks quite richly valued. This creates an ideal time to think about a more value-oriented approach to investing in our minds, which is how we approach the market every day. In the past, when spreads have gotten this wide, it has foretold an exciting period of relative performance for value stocks. From a positioning standpoint, we run in a concentrated style. While concentrated at the security level, we also maintain a distinct focus on diversification across different sectors, market caps, and core business drivers for our holdings, paying close attention to the cyclicality and defensive qualities of the names we invest in. We are also typically a very long-term holder of stocks we buy, targeting an 18 to 36-month time horizon at the outset of an investment. With that summary, I want to thank you for your time in listening to an overview about our equity income strategy. And please reach out to your Manning and Napier consultant to learn more about it.